Let's go ahead and continue with the budgeting side of the house. And the term that we're going to be talking next about is the master budget. If you think about a master budget, that must mean there are sub-budgets associated with that master. So we're going to take a look at that, and we're going to share the screen now and go over to our budget approach. And we'll see that we have a master budget which groups multiple budgets and supporting schedules together. So we ultimately, the result is going to be a pro forma or budgeted income statement and balance sheet. But initially, we're going to start, and we'll talk about sales and talk about expenses and trying to figure out the budgets to go with that. Then we'll have a cash budget. We got to track how much cash is coming in, being received, how much is being dispersed. We then might even have additional financing. So that's another source of cash or payback of financing as a use. So the master budget is a complex set of documents, but it's based on what we do and how we do it. So let's look at our cycle. If we're looking at our operating cycle, we have cash coming in and cash going out. So we start with cash and we buy stuff, purchase or manufacture things. Cash goes out the door. We make inventory or acquire inventory or both. Then that inventory is going to get sold, sales of product and or services that go with that. We're going to generate receivables. There'll be some cash sales likely, but most businesses, B2B, business to business, is considered accounts receivable, which will eventually be collected and turned to cash. And so that's our operating cycle of a manufacturing or a merchandising operation. This is a big picture that you want to get a handle on, and you want to have a pretty good understanding of the relationships here. We mentioned that everything starts with sales. Our sales budget determines what we expect to go out the door in the form of sales to customers. From there, we can determine how much stuff we need to get to sell. So we have a purchases budget, and the purchases is going to take the form of buying inventory. And then the wholesaler will sell to the retailer, or the retailer will sell to the consumer, B2B or B2C. But the purchases are dictated by what we expect our sales to be. We also have two other kinds of expenses that go out the door: selling expense budget and a G&A expense budget. You've probably heard of SG&A. Shows up on an income statement pretty frequently. We've been seeing those in Edgar on our income statements, and you're probably seeing those in analysis as you do your projects. So we have a selling expense budget separate from the G&A expense budget, but that's a total of selling general administrative expenses. That will yield a cash budget. So the cash budget includes from the sales budget our revenues, and spaced out depending on when we expect to get paid, the receivables to be paid. But we also have our payables, and we have to pay our vendors, we have to pay other suppliers, we have to pay for utilities, rent, labor, anything else that goes with that. All is reflected in the cash budget. Additionally, there may be some special budgets. We might have a capital equipment budget. We might be purchasing some major purchases or selling some things off. Into our cash budget also goes loans that we either have to pay back or we initiate. We may have a shortfall. We may tap on a line of credit from the bank saying, yeah, we need a payroll to make payroll. We need an extra cushion of $50,000. And again, that comes out of the cash budget, but it will project when you need to make sure the bank is ready to give you those funds that you need, or you can plan on some longer term financing as well, or issuing of bonds. And then we have the budgeted pro forma statements or budgeted income and budgeted balance sheet based on all of the above. So that's kind of how the picture, how it fits together, how it looks together. So let's take a sales budget example. Bottom line, we have unit sales times the revenue per unit. And in this case, we have 9,000 units sold and a selling price of $10 per unit, which yields a sales revenue of $90,000. So that's giving us budgeted revenue of $90,000. We're then going to have to figure out what's going to support that $90,000 or those 9,000 units. So we have purchases. We forecast the purchases to meet the sales needs. So that's why we start with sales. And we also have to include inventory requirements. We have some beginning inventory, and we want to have a cushion for ending inventory. So we consider the budgeted sales, what we want for ending inventory, and what's the planned beginning inventory for the following period. Purchase budget example, here we go. Sales needed, desired ending inventory, less beginning inventory, and we get a purchases, not only a units number, but a dollar number to go with that. And in this case, we're anticipating a $10 planned sales increase per month. And that's what we budget for. Our selling expenses, in addition to the materials that we have to buy that are resold, we pay commissions, and then we have a cushion, a miscellaneous cushion. And we also include our fixed selling expenses here, depreciation on equipment, building, and whatever other tools we have. Advertising. You say, isn't advertising variable? Well, we're considering it fixed because we're going to have a standard amount every month that we are putting in this case, the month of June, for advertising. Yes, we can adjust that. It's a little bit easier to adjust than depreciation would be. We also have a miscellaneous category of where we have some additional funds that we basically put in a holding pattern. Total fixed expenses, total variable expenses yield our total selling expenses. Then we have our G&A, general administrative stuff. And we look at salaries, insurance, depreciation, utilities, and miscellaneous. It looks like miscellaneous is the third highest there. Accountants don't like miscellaneous. It's too broad and subject to interpretation. So we try to get as specific as we can, typically in a budget. But again, you do build in some cushions to go with that. So here's our total general administrative budgeted costs to go with that. Then we have our cash budget. All cash receipts and disbursements are summarized here based on the receivables expected when they're going to be paid. Maybe the first month we get 10% cash sales, 20% are paid in the first 30 days, and the remaining 70% is remaining. Rarely do you collect 100%. So maybe you budget 68% in the second month or second and third month, and you kind of age it to go with that. And you do the same thing for your own payables, the bills you're going to pay. Cash budget example here. So we budgeted what we have in sales. We estimate that 40% of sales are cash, 60% are credit. Of those 60%, 30% are collected in the month of sale, and 70% are collected in the following month. Collecting 100%, good deal. Beginning cash balance is $15,000, and sales during the May were $86,000. So we go ahead and project out how much in cash collected, and then how much in the current month, and then how much for next month, and we get some total budgets to go with that in our or from last month, in the prior month, actually, in this case, 70% for the prior month. So we're looking at that and saying, great, we have a number we can hang our hat on. Is it accurate? That's anybody's guess, but that's the budget. Again, it may or may not turn into reality. We may collect more, we may collect less. If you recall, the cash flow statement starts at the beginning cash balance, has an ending cash balance, and then we have flows of cashes, operating, investing, financing. Here we have flows from our revenues, from our sales, and flows from our expenses. We had our production expenses, we had our selling expenses, and our general administrative expenses. Now we have two parts of the cash budget, the cash receipts and the cash disbursements. So we have a cash receipts budget example, and this goes in, again, allocating the percentage what we expect to collect based on the purchases on the sales we had. And the cash disbursements goes in and says, oh, we have all kinds of expenses that we're incurring. That's what's going to go out the door that we have to pay and incorporate on our cash budget. A third section on the cash budget, I mentioned earlier, we might take out some loans to cover, to be a cushion, or we might be paying back some loans or paying interest. Often in a cash budget, you say, well, here's the cash cushion. The same way we have an inventory cushion, we have a cash cushion we want to maintain, and we may draw on our line of credit at that point, or need to go to the bank to request a loan or seek out additional sources of financing of cash from wherever we may be able to get them. So here is a complete cash budget. Cash receipt section based on our sales and our receivables collections. A cash disbursement section based on the checks we're going to write, we're going to pay as we go. And then the financing section. And we have interest associated with that. So we have a complete cash budget here. We do have a cash beginning balance and a cash ending balance, which, as you recall, on our cash flow statement, we had the same thing. Also on our balance sheet, we had last year's ending balance, which is this year's beginning balance. And then we have the ending balance. Now, this is a monthly budget. Again, we're here in the month of June. And that's going to be the flow associated with that. So here's our budget income statement. So now we get a pro forma. We project and say, oh, what's the sales look like? Oh, this is all dollars now, not units, but dollars coming in the door. We have a beginning inventory. We buy some stuff. We've got goods available for sale, or goods and cost of merchandise available for sale, and an ending inventory. Ultimately, we've looked at inventory before. We take our beginning inventory plus purchases. We take out our ending inventory. That yields cost of goods sold. We can calculate a gross profit. Then we look at the rest of the income statement, our selling expenses, our G&A, general administrative expenses. We have income from operations. We have interest expense. We have income tax expense, and we have our net income. So we have our bottom line as profit projected. That's not our cash statement, but that's our income statement to go with that. We also have our budgeted balance sheet. And again, this is a monthly basis. We have our cash from our cash budget. We have our inventory, which came out. We have our income statement, income taxes payable. We have our equities. We have previous balances. These are all coming out of the budget or previous balance sheet that we had. And before finalizing the budget, we asked two questions. Is it feasible? Does it make sense? And is it acceptable? I mean, if we're budgeting big losses, you aren't going to say, I don't want big losses. So we got to go back to the budget and figure out how to mitigate that. Do we need to do some more marketing? We need to change some pricing. Are we going to play with our pro formas and say, that's going to help us make some decisions? We're going to talk a little bit later about the process of establishing a budget, top down or bottom up, and the motivations for management. But right now, you want to eyeball it. And by the way, every time you do an analysis, you look at numbers on a spreadsheet, you want to eyeball those numbers and say, is this reasonable? Is it feasible or acceptable? Does this make sense? Is this something we can hang our hat on? Is it something we could sell to the board? Is the public going to be happy? Will our investors be happy? Will our employees be happy? Will our management be happy? We want everyone to be as happy as we can, but we also need to stay in business. So let's talk about the manufacturing side of the house. The last examples were based on purchasing inventory from other parties, stocking it, and then reselling it here, whether we're selling it business to business, from wholesale, from production, manufacturer to wholesaler, wholesaler to retailer, or business to consumer, retailer to consumer. But now we've got a manufacturing element here that if we're making cars, we got to figure out, well, how many batteries and tires and engines and windshields we have to buy or make to produce. So we're going to be buying raw materials. We're going to be converting those raw materials into work in process, and then ultimately into finished goods. So we're not only going to have materials, but we're going to probably have labor, or definitely will have labor, and overhead associated with that. So we're going to take a look at a production budget. We're looking at a manufacturing organization. We are supporting the sales that are going out the door. We have inventory, finished goods inventory requirements, but we need to buy pieces and parts to make those finished goods. There's a technical term called bill of materials, which is everything that's associated with the finished goods. And the bill of materials is going to include, say for a car, we got tires, we got seats, we got engines, we got speedometers, we got lights, we have all kinds of things associated. To make one car, we need a certain quantity of all those materials to go with it. That's called our bill of materials. So our production budget, we have sales in units. Again, we tag the inventory that we're looking to have, desired ending inventory. So how many carts are required? Less the beginning inventory of carts. We need to budget production of over 9,000, in this case, 9,180 carts, which is going to be made up of stuff. I think they're made up of wheels and plastics or resin. There may be other pieces and parts that are associated. I think those are the only two we'll use for an example here, though, to see what our manufacturing budget needs to look like. So we got the production budget. Now we go to a purchases budget. And you recall the purchases budget said previously we were just buying inventory. Now we're buying materials to produce our finished goods. So we want to have 10% of the materials needed for next month's production in stock at the end of each month. 6 pounds of plastic resin is required for each cart. We had 5,508 pounds of resin on hand, and it cost 21 cents per pound. So if we're looking here, the amount of resin we need, 6 pounds times 9180 carts. These are in units. These are not in dollars yet. We'll get to dollars soon enough. But right now we're looking in units and desired ending resin inventory, total resin requirements. We're looking at pounds of resin, less beginning inventory resin, total purchase of in pounds that we need to budget for of resin. And we do the same thing for the wheels. Carts have wheels, right? So we've got 10,009, we're producing 10,098 carts in July. Want to have 10% of the materials needed. Wheels are 30 cents a piece. Again, we're not going to use the price yet, but we will soon. We're going to look at the number of wheels, desired ending wheel inventory, total wheels requirement, less beginning wheels equals wheels purchased. Again, that's a budget, a purchase budget of what we need to acquire of the materials to make these carts. So here's our purchases budget example. So here's the resin in pounds, total resin we needed to acquire, resin pounds. We have wheels, total number of wheels. And then we now factor in the cost of 21 cents per pound for resin and 30 cents per wheel. Total purchases in dollars comes out to $17,246 in this example. And finally, last slide for this segment, we have the following costs per unit. But notice that we not only have the materials, the resin of the wheels, we have labor and variable overhead and fixed overhead. So we've seen that before in terms of variable overhead, fixed overhead being added, labor being added, and materials being added, direct materials. So here's our budget. Total manufacturing costs include everything, materials, labor, and overhead. And it does feel kind of strange when you start saying, well, my inventory has labor in there, my inventory has overhead, and we've talked about this. The inventory in the balance sheet for a manufacturer does include labor and overhead as part of the inventory, not just the materials, not just the raw materials. The work in process has some labor, and the finished goods definitely has labor to go as well. So that gives us an idea of the budget cycle, the master budget, and the manufacturing budget to go with that. So that takes a look at where we're at. We have one more video for this module we'll take a look at, and we'll look forward to welcoming you back. Thank you.